Hi, it's John Mousseau. I'm the President, CEO, and Director of Fixed Income at Cumberland Advisors. It's Friday afternoon, December 18th. Quiet week in the bond market. Yields ground a little higher. 10-year Treasury bond went from 0.89 to 0.94. That was up 5 basis points. 30-year Treasury bond went from 163 to 169, up 6 basis points. This is with the backdrop of even some bad news, higher initial jobless claims. Obviously, big parts of the country shut down or more or less shut down again because of the resurgence of COVID. Yet, even with that, we saw yields creep higher. Why is that? No question, the vaccines, now the Moderna vaccine also out there to go along with Pfizer. Hopefully, vaccines become more expansive as we go on through the holiday season into next year. The markets are starting to look towards a economy where more people get vaccinated and we are moving our way back to some form of normalcy. We think that will be the case going forward. There's no question that the municipal bond market didn't see any yields move up this week, or maybe 1 basis point. I think the 10-year AAA scale in Munis is at 0.71. 30 years about 138. They hardly moved. Those ratios of muni to treasury yields in the high grade area are essentially 75% and about 82%. That is absolutely remarkable when you think about just a couple of months ago, those ratios were well over 1%. What's caused this? Partly understanding that municipal credit is overall very solid. So that's certainly been one aspect of it. We think a bigger aspect, there's a lot of buying going on in municipals, has been particularly since the big supply bulge that we talked about back in October with issuers trying to beat the rush to the election. Yields have come down since then, since that supply is behind us, not in front of us. But also there's something more at work, and we think that's the fact that people are starting to discount a tax hike next year with a new Democratic administration led by President-elect Biden. How big a tax hike we get, we don't know. A lot of it is going to depend on what we see on January 5th with the Georgia Senate races. Very important on two aspects. Number one, if we get a Democratic Senate, which means a 50-50 with a vice president breaking the tie, that means that not that you're going to necessarily get more spending, but the perception will be that you will get more spending. And that would probably send bond yields higher because you would get higher levels of spending as well as probably a higher degree of aid out there. And that would be on top of the bill that we're already expecting Congress to pass. You'd probably see yet another bill. And along with that, on the muni side, whereas the munis are doing so well, they would expect a tax hike, whether we go back to 39.6 or maybe higher to beyond 40%, to be determined. There's no question, though, we think those things are at work in the market. Big demand for munis, overall look at higher rates as economic activity picks up. It'll be higher in any case. The perception will be higher if you have a Democratic administration with a Democratic Senate, as well as we know the Democratic House. And there'll be more laws and spending passed more easily. We think that, certainly with the economy jump-starting its way with the vaccine, that next year will look a lot different than it feels right now, for sure. And the bond market's starting to reflect that a little bit. Next week will be a quiet week. We will look at the initial jobless claims. Again, we'll try to come back to you on Wednesday before the holiday week shuts down. And we hope you have a very good weekend this weekend. Thanks a lot.
Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors. 12/18, closing in on the end of the year. What a year. We learned some of the same lessons that traders and investors have learned over the last 80, 90, 100 years. And that is to try to stay reasonable in the face of violent moves in the market. Going back to March, April, it has paid to try to ask what can go right. Or how much of this negativity is priced into the market? Now, as we have that run off of March through the summer, through the fall, we have to start asking the same question, but in the other lens. What can go wrong? What are we not seeing here? You've probably seen on Bloomberg and CNBC, the large investment houses' 2021 predictions, different advisors' 2021 predictions. Seems uniformly talking about gains, loose Fed, economy coming back with the vaccines. Keep in mind, those things are known now. Those things are in stock prices. Right now, we make no changes to our portfolios. We like the way they're trading. Certain sectors are on fire when you look at solar, when you look at wind, really nice positions in our U.S. equity portfolio. Also biotech, over on tactical, very strong in biotech. Some nice moves in equal weighted technology. Over in international, Asia continues to trade well. South Korea, Taiwan. China's taken a little break lately, but a very solid year-to-date move. Sometimes when I say China, I get feedback, negative feedback. That's always something we need to battle as traders, is any kind of emotional attachment to a market or security. What I think or don't think about how China runs their economy or deals in trade with other countries, it can't affect what I think about a security. That's something we have to battle daily, weekly, monthly, is trying to getting too emotionally attached to positions. You see it often with gold investors. You see it with Bitcoin investors. You see it often in tech investments. There are reasons to own all of those. There are also reasons to stay away from all of those in different market cycles. So we try to stay reasonable. We try to look at everything through a risk-reward prism. Right now, our latest trade was last week when we let go of the banks. We sold the banks in US ETF. So right now, we're sitting at about 18% cash in US. Something will raise its head. Something will give us an opportunity. So far, it looks like that opportunity may come from small and mid, where we have a nice position, but probably not enough when we look at this daily performance. Love to see a little pullback there. It won't feel good buying that pullback, by the way. It's easy to say until it happens. But if you're looking at different things analytically, there are some levels we'd like to get some of that cash in. Next week, look for our video on Wednesday. Christmas Eve, Thursday, very quiet day. Obviously, markets closed on Friday. Everyone enjoy the holidays, and we'll be back at you for the new year.